What does the coppock curve tell you? The coppock curve was originally implemented as a long-term buy and sell indicator for major indices such as the S&P 500 and the Wilshire 5000. Often, it is used with long-term time series such as a candlestick chart, but where each candle contains a month's worth of price information. When the indicator is above zero, it indicates a hold. When the indicator drops below zero, it indicates a sell. And when the indicator moves above zero, it signals a buy. Beyond the signals above, the curve will often appear uncorrelated to price. This is due to the long-term lagging nature of the indicator. Example of how to use the coppock curve: apply the coppock curve to a monthly price chart of a stock index or stock index exchange traded fund, ETF. The general strategy is to buy when the curve rises above the zero line and consider selling when the curve falls below zero. For investors who already own the ETF, when the coppock curve is above zero, the indicator is signaling to hold onto the investment. The coppock curve is a momentum indicator developed by Edwin Sedge Coppock, who was an economist by training. Coppock introduced the indicator in Barron's in October 1965. The goal of this indicator is to identify long-term buying opportunities in the S&P 500 and Dow Industrials. The signal is very simple. Coppock used monthly data to identify buying opportunities when the indicator moved from negative territory to positive territory. Although Coppock did not use it for sell signals, many technical analysts consider a cross from positive to negative territory as a sell signal. Chartists following the two sell signals would have avoided the last two bear markets. The February 2001 sell signal would have avoided most of the bear market from 2000 to 2002. The June 2008 sell signal would have gotten investors out before the market plunge in the second half of 2008. These sell signals could have been used to simply exit the stock market and move into cash, which would have lowered market exposure and overall risk. Flexibility as noted above. The coppock curve is simply a smooth momentum oscillator. The rate of change indicator measures momentum and the weighted moving average smooths the data. This means the indicator can be used on any time frame. Intraday, daily and weekly data can be used to fit one's trading/investing style and time horizon. The chart below shows the coppock curve using weekly data on the Dow Industrials. As expected, the weekly chart produced many more signals than the monthly chart. The goal of this indicator is to identify long-term buying opportunities in the S&P 500 and Dow Industrials. The signal is very simple. Coppock used monthly data to identify buying opportunities when the indicator moved from negative territory to positive territory. Although Coppock did not use it for sell signals, many technical analysts consider a cross from positive to negative territory as a sell signal. The coppock curve is simply a smooth momentum oscillator. Even though it was originally designed for monthly charts and long-term analysis, it can be used on intraday, daily or weekly charts, and the settings can be adjusted to suit one's style. The main signals are generated with crosses above and below the zero line. More aggressive chartists can consider looking for bullish and bearish divergences to anticipate such crossovers. Be careful though. Divergences do not always result in trend reversals because the trend can simply slow and continue in the same direction. The rate of change indicator is a momentum oscillator that oscillates above and below the zero line. Coppock used 11 and 14 periods because, according to an Episcopal priest, this was the average mourning period when grieving the loss of a loved one. Coppock theorized that the recovery period for stock market losses would be similar to this time frame. The rate of change indicators were then smoothed with a weighted moving average. As its name implies, a weighted moving average puts more weight on recent data and less weight on older data. For example, a 3-period WMA would multiply the first data point by 1, the second data point by 2 and the third data point by 3. The sum of these three numbers is then divided by 6, which is the sum of the weightings, 1 plus 2 plus 3, to create a weighted average. Using monthly data, this indicator will not trigger very many signals. A buy signal triggers with a cross into positive territory, while a sell signal triggers with a cross into negative territory. As noted above, the